We're kicking off today's deep dive with a deal that's turning heads in the cloud infrastructure space. Pinterest has signed a $4 billion multi-year cloud services agreement with Amazon Web Services, one of the largest publicly announced cloud migration commitments of 2026. This isn't just a vendor swap. It's a strategic infrastructure overhaul signaling that Pinterest management is betting big on AWS as the backbone for its artificial intelligence and machine learning ambitions. Against a backdrop where the S&P 500 sits at 7,516 and the VIX is ticking up to 16.38, this kind of long-horizon CapEx commitment speaks to genuine conviction in the cloud scaling thesis. Pinterest has formalized a $4 billion multi-year contract with Amazon Web Services, making this one of the most significant enterprise cloud migration deals announced in 2026. The agreement covers core cloud infrastructure and, critically, extends into AWS artificial intelligence and machine learning service stack, the tools Pinterest needs to power its content recommendation engine and its increasingly personalized visual discovery product. AWS cloud wins of $3 billion or more annually are viewed by Wall Street as hallmarks of genuine enterprise stickiness, and this deal clears that bar comfortably. The commitment also gives Amazon's cloud segment a substantial, visible revenue stream extending well into the multi-year horizon. The real driver here isn't just cost optimization, though that matters. Pinterest is fundamentally retooling its recommendation engine for the generative artificial intelligence era, and the choice of AWS signals it wants deep integration with services like SageMaker and Bedrock rather than building proprietary moneyline pipelines from scratch. Social platforms are in an arms race to surface personalized content faster and more accurately, and cloud-native artificial intelligence tooling is the competitive moat. Wall Street has been watching Pinterest's cloud strategy as a tech modernization lever for some time. This $4 billion commitment answers that question decisively. Management is prioritizing infrastructure efficiency and artificial intelligence scaling simultaneously, a combination that directly targets both revenue and margin improvement. Starting with Pinterest, if execution is clean, this deal could become a meaningful operating leverage story as artificial intelligence-driven ad personalization improves return on ad spend for the platform. For Amazon, this is another proof point for AWS enterprise win rate and supports cloud segment multiple expansion. The deal also puts competitive pressure squarely on Microsoft Azure and Google Cloud, both of which have been aggressively courting social and media sector workloads. Salesforce, which competes in adjacent enterprise software layers, watches closely as more workloads consolidate on hyperscaler infrastructure rather than fragmented SaaS stacks. The communications and technology sectors both benefit from the capital flowing toward modern cloud architecture. For traders and investors tracking this deal's transmission into prices, the key things to monitor are: first, Pinterest post-announcement momentum and any management commentary around margin guidance updates tied to the new infrastructure cost structure. Second, watch Amazon's cloud segment disclosures in upcoming earnings for revenue recognition patterns tied to deals of this size. On the macro side, the 10-year Treasury Yield sitting at 4.46%, down 0.71% today, suggests a mild risk-on tilt that is broadly supportive of growth CapEx spending by enterprises. The broader backdrop is one where investors are rotating toward growth and quality infrastructure stories like this one. The bottom line is this: the $4 billion Pinterest AWS deal is a concrete data point confirming that enterprise cloud migration momentum is intact in 2026, and that hyperscalers, especially Amazon, are capturing the largest, stickiest commitments as artificial intelligence infrastructure spending accelerates. Investors holding cloud-exposed names should treat this as a positive read-through, while those watching Pinterest specifically should track whether management translates this infrastructure bet into measurable margin improvement over the coming quarters. That's the full picture on the Pinterest AWS deal. Coming up next, we turn to a story that's moving energy markets and sending shockwaves through a very different corner of the trade. Shifting now from equity markets to the macro data that's quietly setting the ceiling for everything we've discussed today. The Federal Reserve's preferred inflation gauge just crossed the tape, and the number is exactly what Wall Street expected, which in this environment is almost a relief. April's core personal consumption expenditures index printed at 3.3% year-over-year, matching consensus to the decimal. Headline PCE came in at 3.8%, also on target. No shock, no panic, but no green light for rate cuts either. The market is down modestly this morning, and this data print is a big reason the market isn't celebrating. Let's be precise about what landed this morning. The Bureau of Economic Analysis reported April core PCE at 3.3% on an annual basis. That strips out volatile food and energy prices, which is precisely why the Fed leans on it as its primary real-time inflation signal. Headline PCE, which includes those volatile components, printed at 3.8%. Both figures met consensus expectations exactly, meaning no analyst on Wall Street was caught off guard. The 10-year Treasury yield is sitting at 4.46% this morning, suggesting bond markets had already priced this in. The VIX is at 16.38, up slightly, reflecting residual macro unease even without a surprise. Here's the critical context the headline misses. Matching expectations is not the same as good news. Core PCE at 3.3% sits 65% above the Federal Reserve's explicit 2% long-run inflation target. The fact that it landed on forecasts simply means the Fed has no new reason to pivot dovishly, but it also has no new data to justify holding rates at current levels indefinitely without political blowback. The disinflation trajectory from prior 2025 levels has been gradual, not decisive. What this print confirms is a sticky inflation regime, one where price pressures aren't accelerating but aren't retreating fast enough for the Fed to build conviction around a near-term rate cut cycle. Let's map the transmission to specific assets. The S&P 500 and the NASDAQ 100 are modestly lower. Tech is holding up relatively better because there was no upside inflation shock to compress growth multiples further. Long-term treasuries and TLH, the long-duration treasury ETFs, face a constrained environment. Yields didn't spike, but they're not falling fast enough to generate meaningful price appreciation in long bonds. Gold futures are up solidly. The safe haven bid is real when inflation remains sticky and real returns stay uncertain. The 5-year yield at 4.17% shows some policy accommodation is already being priced at the shorter end of the curve. The single most important level to monitor is the 10-year Treasury yield at 4.46%. Analysts treating the bond market as the macro barometer are watching for a clean break below 4.35%. That would signal a genuine disinflationary shift and ignite a rally in long-duration assets, including long-term treasuries and growth names in the NASDAQ 100. Above 4.46%, the equity multiple compression story stays intact and defensive rotations into dividend plays, healthcare, and staples continue. The 5-year at 4.17% versus the 10-year at 4.46% shows a curve that's still pricing uncertainty on the medium-term growth and inflation mix. The next Fed meeting and any commentary on the pace of disinflation will be the pivotal catalyst to watch. The bottom line is this: a 3.3% core PCE print that matches expectations removes the tail risk of an upside shock, but it absolutely does not give the Fed room to cut, and it confirms that equity multiples in high-growth tech face a structural ceiling as long as real rates remain elevated. Energy prices have fallen, adding a soft demand signal that could weigh on energy earnings without meaningfully relieving broader inflation. The playbook here favors dividend payers, value sectors, and inflation hedges like gold over momentum growth through mid-year. Those are the two stories that matter most today. Full breakdown is up. If this deep dive breakdown is the kind of analysis you want every single trading day, hit subscribe right now and tap the notification bell so you never miss a market open recap. Every morning we break down the data that moves your portfolio. No fluff, just the numbers and the macro context that actually matters. See you tomorrow.